You know, commercial banks hold a tremendous amount of power in shaping our society. By deciding who gets a loan and who can open an account, they're literally the gatekeepers of economic opportunity. Now, we've all seen those glossy corporate commercials, right? Banks promising to invest in local communities and support small businesses. But a major question kind of lingers. Are these just empty corporate promises, or are they actually driving real change? Well, welcome to this explainer. Today, we're jumping right into the exact metrics used to track true financial inclusion. Here's our roadmap for today. Think of this as a blank scorecard we're going to use to grade a bank's real commitment to underserved communities. 1, the financial inclusion scorecard. 2, funding Main Street. 3, tracking the risks. 4, banking the unbanked. 5, building financial literacy. And 6, the bottom line. Okay, section 1, the financial inclusion scorecard. Let's establish exactly why we need a standardized way to measure financial inclusion in the first place. Seriously, is your bank actually helping the community, or just saying they are? Because it is incredibly easy for a bank to publish a beautiful brochure claiming they help people, but without hard data, those claims are practically meaningless to investors and to us as consumers. And that is exactly where the Sustainability Accounting Standards Board, or SASB, comes in. They've created a strict, standardized set of metrics for commercial banks. It basically acts as the ultimate transparency solution, almost like a corporate lie detector that forces these banks to put real, comparable numbers behind their big community promises. The SASB framework relies on a really strict, standardized table of metrics. We're going to focus specifically on the financial inclusion and capacity building section. This is the exact framework banks must use to report to the public, and we're going to break down exactly what goes into these requirements. Section 2, funding Main Street. Let's transition over to the first major metric on our scorecard, which is how banks provide vital capital to small businesses and community development projects. So the parameters of what actually counts here are incredibly strict. A bank can't just hand out a bunch of residential mortgages and claim they're championing community development. No way! According to the standard, qualifying loans are specifically those that fund community services for low or moderate income individuals or help revitalize those specific regions. We're talking about loans to farms, microfinance lenders, and social banks. Things like personal expenditures and regular residential properties, those are strictly excluded. This ensures the data reflects actual on-the-ground community impact. Now, the absolutely crucial point here is that when banks report on these qualifying loans, they have to give us two very specific pieces of data. They must transparently report both the total number of these loans and the total financial amount outstanding. And why does this matter? Well, think about it. It completely prevents a bank from making, say, 1,000 tiny, insignificant loans just to artificially boost their headcount, or making one massive loan and claiming widespread community support. By requiring both the number of loans and the actual dollar value, we get a totally clear picture of their real financial footprint. Moving on to Section 3, tracking the risks. Handing out money is one thing, but how do banks monitor the risks of these loans to prevent predatory practices? This builds right on top of the previous metric. It's really a two sides of the coin situation. Just as banks have to report the number and amount of loans in good standing, they are also required to report the exact number and financial amount of loans that are past due, non-accrual, or subject to forbearance within these exact same community programs. This metric is absolutely vital. It shows us the bank's balancing act. Are they extending credit responsibly, or are they just engaging in reckless lending to hit some inclusion quota, which ultimately sets vulnerable small businesses up for failure? This is the data that exposes the truth. Section 4, banking the unbanked. Let's move down from the macro level of business loans to the micro level of the individual, specifically looking at no-cost checking accounts for the community. To really grasp this metric, we first need to define the unbanked. These are individuals and families who have rarely, if ever, held a standard checking or savings account. They are entirely outside the traditional financial system. Under the SASB standard, banks are required to report the number of no-cost retail checking accounts they provide specifically to this population. And when I say no cost, I mean exactly that. Core services without extra fees, zero monthly maintenance charges, and no minimum average balance requirements. For people trying to build financial stability, an account like this is literally a lifeline. Now, the standard also requires tracking accounts provided to the underbanked, and this is a super crucial distinction. The underbanked might technically have a basic checking account, but they still heavily rely on alternative financial services. Think expensive money orders, rent-to-own schemes, or those exorbitant payday and auto title loans.
By tracking exactly how many stable, no-cost accounts are provided to this specific vulnerable group, we can see if a bank is actually helping to rescue people from predatory lenders.
Which brings us to Section 5, Building Financial Literacy. Supplying accounts isn't enough on its own. Let's explore how the scorecard grades a bank's effort to actually educate the community. Because to truly empower the unbanked and underbanked, knowledge is just as important as capital. Banks actually have to report the total headcount of unique participants in their financial literacy initiatives. And the standard is beautifully broad on what qualifies, which allows banks to get pretty creative. They can track participation in formal educational programs, local workshops, seminars, long-term courses, direct financial counseling, and even various community partnerships. The ultimate goal here is to document actual, real humans receiving actual education. And here's a really surprising, actually brilliant feature of this standard. Banks don't have to do it all of themselves. They are totally allowed to count initiatives provided by contracted third parties. This means a bank can leverage specialized local community partners who already have the trust and the cultural competence to effectively teach financial literacy in specific neighborhoods. It makes perfect sense. The bank provides the funding, the community partners provide the expertise, and the bank gets to report the positive headcount. It's a total win-win. And finally, Section 6, the bottom line. To wrap up our explainer, let's step back and examine why all this transparency secures long-term value, not just for the community, but for the banks themselves. There's a quote from the standard that perfectly summarizes the core philosophy here. It states that meeting the need to extend credit while avoiding predatory and irresponsible lending practices may create long-term value and improve brand reputation. And that hits the nail on the head. Financial inclusion isn't just about charity. It is fundamentally good for business. Banks that successfully tap into unbanked markets and support growing small businesses are basically creating their own future customer base. And by doing it transparently and responsibly, they mitigate massive regulatory risks while building unbreakable brand loyalty. So we've walked through the scorecard. You now know exactly what to look for: the number and dollar amount of small business loans, the actual health of those loans, the true volume of no-cost checking accounts for the unbanked, and the real headcount in financial literacy programs. That data is out there right now in their sustainability reports. So my final question to you is this: have you looked up your own bank's data? How did they actually measure up on the financial inclusion scorecard? I highly encourage you to go find out. Thanks for joining me for this explainer, and keep asking the right questions.